Hi everyone, welcome to this video. This is Mark with Ease Investing. Today we're going to talk about a concept called velocity banking. In this example, we're going to use a $500,000 home with a 20% down payment, so a down payment of $100,000. We're going to say that someone took out a $400,000 loan at a rate of 6.25% for 30 years. And with this loan amount, the monthly payment would be $2,462.87. So after paying this loan for 12 months, this person has paid a total amount of $29,554.43. What would you think if you had paid a total of about $30,000 right here over 12 months? How much would you think you have left on your loan after year one? Well, let's break it down. Out of that $29,000, roughly $30,000, about $25,000 went towards interest. So that went to the bank. It did nothing for your loan balance. This is called your principal loan balance. It did nothing with that. The $4,687.14 did go down to pay your $400,000 loan. So that leaves you with a balance of $395,312.82 left on your loan. So you could see after year one, about 1/5 of what you paid went actually to paying down your loan. The rest of the money went all the way to the bank for them to keep. So you basically threw that money out the window by taking out the loan. The problem with paying your loan back with this mindset is you pay interest first. And then after you pay the interest, you leave what's left over to pay down the principal. There is a better way to do this called velocity banking. Velocity banking, in a nutshell, is taking out a HELOC and using that HELOC money to pay down your principal first. And then after you pay down your principal, you pay down the interest. So you're doing it in reverse. The problem with doing it the way that the bank wants you to do is you pay the interest first, and then you pay what's left over to the principal amount. Using velocity banking, the big difference is you pay the principal first, and then you pay the interest. And there's a huge difference by paying the principal first and then the interest. Instead of paying this off in 30 years, it will take you about 7 to 8 years paying this off. I'll do more videos on velocity banking, but that's the huge difference is you're paying the principal first and then the interest. Where with a conventional loan, how most people do it is they're paying the interest first and then paying down the principal.